Welcome back to the Deep Dive. Today we're jumping into ACR's Commercial Realty Corp. Tickers ACR just had their Q3 2025 earnings release. And, well, you likely saw the headline. Stock jumped almost 10% right after the call.
Yeah, that stock move, it really says a lot, doesn't it? It tells you where the market's head was at. And our job here really is to figure out, okay, what did they do? What were the strategies, the operational moves that got investors so positive, even if some headline numbers maybe missed slightly?
Exactly. It wasn't just about the P&L this time. Okay, let's hit the top line numbers first, just quickly. GAAP EPS, that came in strong. $1.34 per diluted share. And their key non-GAAP number, earnings available for distribution, or EAD, that was $1.01 a share.
Both solid numbers.
But, and this is interesting, they did actually miss on the consensus revenue forecasts by about, 5.4%?
Right. And normally you might see a negative reaction to that. But like you said, nobody seemed to care much this time because the real story, the thing that grabbed everyone's attention, was the balance sheet, specifically book value.
Yeah. Talk about that.
Book value per share just surged. It went to $29.63.
Yeah. Okay, $29.63. What was it before Q2?
It was $27.93. So that's a huge jump in just one quarter. That kind of move, it just screams strategic execution. It's not an accident.
And it looks like they did that while also improving their financial position, right? Liquidity looked decent?
Very decent. They finished the quarter with $64.5 million in total liquidity, healthy cushion.
And the leverage. That's always key for these CRE lenders.
Yeah. And good news there, too. The GAAP debt-to-equity leverage ratio actually went down.
Down? How much?
From 3.0x down to 2.7x.
Okay, 2.7x, that's a noticeable drop. Delevering while growing book value like that is pretty impressive.
It absolutely is. And it gives them, more dry powder, more flexibility for Q4 and beyond. And that leverage decrease, it ties directly into the main event of the quarter, what you could call the DTA play.
All right, the DTA play. Let's unpack that because, like you said, this seems to be the core reason for that stock pop. We're talking deferred tax assets. How exactly did they use one single sale to boost both GAAP EPS and book value so dramatically?
Okay, so this is where it gets a bit more strategic than just standard earnings. Management sold one of their real estate investments, and that sale generated a pretty substantial gross capital gain, $13.1 million.
$13 million, okay, big gain.
Huge gain. But the crucial part, the really smart part, was how they handled it. They used the company's existing deferred tax assets and also some capital loss carry forwards to essentially shield that gain from taxes.
So they offset the gain. Meaning it didn't trigger a big tax bill.
Exactly. That $13.1 million gain could flow through, largely tax-free, straight into shareholders' equity.
So it directly boosted book value.
Precisely. When you can realize a gain like that without giving a big slice to the tax man, you're unlocking value that maybe the market wasn't fully pricing in before. It's balance sheet optimization at its finest. Using those, let's call them paper losses from the past, to generate very real, tangible equity today.
And that explains the $29.63 book value number hitting so hard. It wasn't just earnings. It was smart financial engineering.
Nailed it.
And reading through the CEO's comments, Mark Fogel, it sounds like they didn't just sit on that cash either.
No, not at all. That's the other key piece, capital recycling. Those proceeds were immediately put back to work, deployed into new commercial real estate or CRE loans. It lines up perfectly with their stated goal of growing the portfolio going forward. They're not just cleaning up the past, they're actively building the future.
Aggressive recycling. Okay, so if they're adding new loans, let's look at the health of the overall portfolio now. How big is it?
It stands at $1.4 billion currently, spread across 46 different investments.
$1.4 billion. And in this environment, everyone's nervous about credit quality. How's it holding up?
Well, the headline stat is pretty good. 92.3% of that portfolio is current on payments.
Okay, over 92% current. That sounds strong.
It is, but, we have to look a little deeper. The weighted average risk rating did tick up just slightly.
Oh, what to what?
From 2.9 up to 3.0. It's a small move, but directionally, not ideal.
And does that translate into specific problem loans?
Well, they noted there are now 13 loans that are rated 4 or 5. Those are the ones carrying higher risk, potentially distressed, or needing more attention.
13 loans rated 4 or 5. Given the rate environment, why didn't the market, freak out about that slight increase in risk?
That's a great question. I think it comes down to a couple of mitigating factors that management really highlighted. First, the income generation from the portfolio is still solid. The weighted average spread on their floating rate loans is 3.63% over 1-month SOFR. That's a healthy margin.
Okay, good income spread. What's the second fact?
Confidence signal through their credit reserves, the CECL allowance.
Right, CECL. Current expected credit losses. They actually lowered their reserves, didn't they?
They did, by a notable $4 million, which translates to about 54 cents per share.
Lowering loss expectations right now. That's a bold move. What was their reasoning?
They cited two things: improvements in their model's assessment of credit risk for the existing loans.
Okay, suggesting maybe those 13 loans are manageable.
Right, contained. And second, a more optimistic view on expected macroeconomic factors going forward. Now, they still have a total allowance of $26.4 million, which is about 1.89% of the loan portfolio at par. So it's not like they've thrown caution to the wind.
Okay, so it's a calculated signal of confidence in the portfolio's overall health, despite that small uptick in the risk rating.
Exactly. It tells the market, we see the risks, we've quantified them, and we feel good about where we stand.
All right, so summing up Q3 execution. Use the DTAs for a big tax-efficient game, recycle the capital immediately, and signaled confidence on credit. Makes sense why the market liked it. Now let's shift to the forward view. What signals are they sending about the future? The buyback seemed like a big one.
Huge signal. The board reauthorized, adding another $7.5 million to the share repurchase program. And this isn't just talk. They were actively buying in Q3. Spent $2.9 million to buy back 153,000 shares.
And the price they paid. That's the kicker, isn't it?
Absolutely. They bought those shares back at roughly a 36% discount to the book value they just reported.
Wow. When management buys back stock that far below book, I mean, that's about as clear a signal of undervaluation as you can get.
It really is. They're basically saying the market price is wrong, significantly wrong, and we're using the company's capital to prove it. It's immediately accretive to the remaining shareholders.
Okay, what about actual portfolio growth? They were recycling capital, but the net portfolio size actually dipped slightly in Q3, right?
It did, yeah. A net decrease of about $46.8 million, which, makes sense given the focus on that big asset sale.
But the guidance for Q4 sounds ambitious.
Very ambitious. Management said they expect a substantial number of new loan closings in Q4. They're aiming for positive portfolio growth for the full year. And they even reiterated their target range for the year-end portfolio size.
Which was?
Between $1.5 billion and $1.7 billion.
To get from $1.4 billion now to $1.5 billion or higher by year-end, they need a very busy Q4.
Absolutely. Execution in the next few months is critical to hit that.
And hitting that growth probably depends heavily on their next big financing move, the CLO.
Directly. The collateralized loan obligation. They confirmed they're actively originating loans right now specifically to build up enough collateral. The plan is to warehouse those loans and then execute the CLO transaction sometime in Q1 of next year.
And why is that CLO so important for them?
It provides locked-in long-term financing for those assets. It's more stable and generally more cost-effective than relying solely on shorter-term warehouse lines. It's basically the engine that allows them to sustainably support that $1.5 to $1.7 billion portfolio target. It's crucial for their growth story.
Got it. Now let's circle back to that book value, $29.63. They've had a long-standing target around $30, haven't they?
They have. For years, that $30 per share book value has been the stated goal, the sort of mission accomplished marker for this phase of the company.
And they're incredibly close now.
Within spitting distance. Management actually commented on this. They said there are only 3 properties left that they need to sell as part of this strategic monetization plan.
Only 3 left. Do they see line of sight on selling them soon?
They indicated reasonable visibility on selling at least one of them within the next couple of quarters. So hitting that $30 target isn't some vague forecast anymore. It feels like a near-term, achievable waypoint. The finish line is in sight.
Which naturally leads everyone to ask the question, the dividend.
The dividend question, yes. Investors have been waiting patiently for that.
What did management say? Any firmer timeline?
They tackled it head-on. The message was clear. They will consider resuming dividend payments after 2 things happen. 1, they hit that book value objective around $30. And 2, this whole mission of selling off the non-core assets and fully utilizing the tax benefits is complete.
So hitting $30 book value is essentially the trigger for seriously considering the dividend again.
That seems to be the explicit linkage, yes. Finish the cleanup, hit the target, then talk dividends.
Okay. Stepping back, how does ACR's performance look compared to, say, the broader market or other mortgage REITs?
It's really night and day, especially recently. Their 52-week return is around plus 36%.
Wow, 36% in this market.
Yeah, compare that to the S&P 500, which is up maybe 17.5% over the same period.
Okay, significantly outpacing the market.
And absolutely crushing its peers. The mortgage REIT ETF, ticker REM, has actually seen negative returns recently, like down almost 2% over the past month.
So ACR has found a way to really stand out.
Definitely. The market seems to be saying loud and clear that this strategy focusing on the balance sheet, using those DTAs smartly, driving book value, is the winning formula right now. Oh, and another small point. They got added to the S&P Global BMI Index. Not huge, but it adds a bit more visibility, maybe some institutional flow down the line.
Right.
Yeah.
Okay, that sets the stage perfectly for our next segment. This is where we look at the situation, the data, the signals, and think about, what could happen, a potential scenario. And just to be crystal clear for everyone listening.
This is not financial advice. Yeah. Absolutely not. We are analyzing information, not making recommendations. Do your own homework.
Okay, disclaimer delivered. So what's the outrageous but plausible trade idea based on everything we've just discussed?
All right, let's call this the value convergence play, or maybe closing the gap.
The premise is simple, and we've touched on it a lot. There's this massive, 36% gap between the current stock price, which is hovering around $21.99, and that reported book value of $29.63.
A huge discount. Exactly. And the core catalyst is management's relentless focus on closing that gap. Their actions, the aggressive share buybacks way below book, the clear roadmap to $30 book value, they create what looks like a pretty compelling asymmetric risk-reward situation. The potential upside seems much larger than the downside, based on their own actions.
Okay, so the idea hinges on that gap closing. What's the actual trade structure you're envisioning here, hypothetically?
Hypothetically, go long ACR common stock. Pretty straightforward, but crucially, with a very defined exit strategy. Set 2 clear triggers for potentially selling.
Trigger number 1.
The company officially announces the resumption of a dividend payment. That would be huge validation, provide income, and likely attract a new class of investors.
Makes sense. And trigger number 2.
The stock price actually hits that $30 per share target, essentially closing the gap to the stated near-term book value goal.
Okay, long the stock, exit on a dividend restart, or hitting $30. It sounds simple, maybe even obvious given the discount. Why is it plausible, though, not just wishful thinking?
Plausibility comes from track record and near-term catalysts. Look back 5 years, management has delivered. Over that time, book value has compounded at 12.7% per year. That's solid.
Okay, 12.7% annual BV growth. Impressive consistency.
And the stock price, that's compounded at an incredible 41.8% per year over 5 years.
41% per year, wow.
Right, so when a management team delivers that kind of performance, especially the consistent book value growth, their stated objective of hitting $30 doesn't feel like a hopeful guess. It feels like the next logical step in a proven process.
And the near-term catalysts support this.
Exactly. You have clear milestones to watch in the very near future. Q4 loan originations, will they hit that $1.5 to $1.7 billion target? Then Q1 CLO execution, will that go smoothly? These aren't distant hopes. They're specific operational goals for the next, say, 6 months, designed specifically to drive value and get the market to recognize that intrinsic worth. The discount just seems too wide to persist if they keep executing.
That lays out a strong case based purely on their actions and stated path. But again, for everyone listening,
this is not financial advice. Purely analytical thinking based on public information. Your investment decisions are your own. Please be careful.
All right. So wrapping up our deep dive on ACR's Commercial Realty's Q3. The big takeaway. This wasn't about minor beats or misses. It was all about strategic execution. Selling assets smartly to use tax benefits, driving massive book value growth, and cleaning up the balance sheet.
Yep. The market saw that operational skill and rewarded the strategy, ignoring things like a small revenue miss. They prioritized the balance sheet optimization.
So a final thought for our listeners to chew on.
Yeah, I'd say keep a laser focus on 2 key things over the next, say, 3 to 6 months. First, the pace of those last few asset sales needed to hit the $30 book value mark. And second, that Q4 loan origination volume. Do they actually originate enough to hit their growth target and set up that Q1 CLO? Because if they nail both of those, will that CLO execution be the final catalyst, the thing that finally convinces management to reinstate the dividend and forces the market to fully close that price-to-book gap? That's the billion-dollar or maybe $1.7 billion question. Keep tracking those milestones.
Excellent points to watch. Great analysis today.
Always a pleasure. Until next time.